Welcome to Real Vision's Trade Ideas. Today we're sitting down with Amelia Bordeaux of Market Compass. Great to have you here for the first time on Trade Ideas.
Thanks, I'm excited to be here. Thanks for the invite.
So since this is your first time, could you give us a little bit of background as to what you do at Market Compass?
Sure. Market Compass is an advisory firm. We're geared more to retail investors, but we do also service institutional clients should they need research. So it's on market education, market research, global macro. It's all global macro with a heavy emphasis on foreign exchange.
And speaking of global macro, what sort of market themes are you looking at today?
There's a lot going on in global macro right now, so it's really exciting. We have a lot of disruption across markets. We have global growth slowdowns occurring in Australia, in Canada, a little bit in the United States, and also certainly the Eurozone. We also have big issues like Brexit. We have housing slowdowns in Canada and Australia. And of course, we still have trade negotiations ongoing between the US and China. So a lot of uncertainty, which is good for global macro because when volatility picks up, that's when we get big directional moves. And in global macro, that's what we look for, a big directional move.
Okay, so a lot of things going on. Let's start out with China and Australia. What do you see going on there?
It's really interesting because China growth has already slowed precipitously, and Australian growth is slowing too. Just last week, the Reserve Bank of Australia had a rate meeting, and they moved to a more neutral stance. There's house prices decline in Australia, and so Australia is getting hit on two fronts, unfortunately for them. They're getting hit domestically with the house price decline, and they're also getting hit from China because China growth slowdown affects Australia because a lot of 30% of their exports go to China. Also, the Chinese growth slowdown affects commodity prices, which affects Australia. And there's a lot of investment that comes from China into Australia. So Australia kind of has a double whammy going on right now. And so how I've been advising clients to play this is to short the Australian dollar.
Okay, so what levels would you be looking at for the Australian dollar?
We have a pretty significant support level at 70 the figure in Australia. So we're looking to sell on a break of 70 the figure. And our first target is down at like 67.45 level. I'd like a stop around 71.45 for that trade. But ultimately, a managed position in Australia would see it down to 60 the figure, so 60 cents. And that's a longer time horizon. That's over a 6 to 8 month period.
Okay.
But that shorter term trade is about 3 months out. Yeah.
Great. And in terms of your view on the Australian dollar, do you see the Chinese yuan weakening from here?
I do. I just think it'll be a gradual process, and I really don't think that they're going to weaken it till after the trade negotiation is done. That's pretty typical. I think they'll just leave it alone, so there's not another variable that has to be discussed during the trade negotiation, not to kind of inflame the situation. But Chinese renminbi is quite illiquid. It's difficult for especially individual investors to trade it without institutional backing, and so that's why, as part of that trade, let's just take the liquid part of it. Let's just take Aussie dollar and let's just short that.
So what do you see specifically as a relationship between the renminbi and the Australian dollar?
It's a really interesting relationship. As renminbi weakens, which it has been for mostly the past year, Aussie dollar weakens along with it. So Aussie dollar really can't pick up in a meaningful way while the Chinese renminbi is weakening. And so people have to keep that in mind too.
Okay, and so now moving on to another area of the world, Canada, what do you see going on there?
Canada is in a housing slump. It's really tough. And they just had a rate meeting last week in which they still have a tightening bias, but they kind of backed away from it a little bit in terms of their central bank. But what was really interesting was also they released Q4 GDP data, and it came out at only 0.4% quarter-on-quarter annual rate. It was really low. And consensus economists thought that it would come in at 1%, but the Bank of Canada's own forecast, and this is what's super interesting, for the fourth quarter was 2%, and it came in at 0.4. So that's a huge miss by the central bank, and it's quite unusual, actually. And so when you look at the numbers, they just had broad-based weakness across the economy. So the consumer spending was weak, housing was weak, exports were weak, and business investment was weak. And where a little bit of the miss came for the Bank of Canada was they expected business investment, not to be weak. And so I think that was a big surprise for them. And on that day, the Canadian dollar did depreciate quite a lot. But I think that there's trouble for Canada Canada, and potentially the economy is slowing even more than the central bank realized. And so we kind of look for those types of dislocations in global macro trading. We look at where the misses are, and that's a big one. And so I definitely see US dollar Canada higher.
And do you see oil playing a role in this as well?
It certainly does. I mean, the Bank of Canada's been talking about this since October, that the decline in oil prices has really impacted the Canadian economy. Jobs are still strong in Canada. I'm not really making a forecast for oil prices, but I do know if the U.S. economy is slowing, they are having housing trouble in Canada, and the oil prices right now certainly aren't helping Canada.
Okay, so what levels are you looking at for the US CAD?
I would try to get in the trade now. So it was currently trading at 133.70. So I would be long dollar CAD from that level. I look for it to move up to 136.40, and I'm going to put a stop down at 132.40.
And what would be your time horizon on that?
This one's a shorter term, so 1 month.
Okay, great. Now, speaking of central banks that are somewhat dovish, we also have the ECB. They seem to be moving in that direction. What do you see going on in Europe?
Europe is in a growth slowdown as well. And so the ECB meeting about a week and a half ago was really interesting, at least Draghi's press conference. They introduced a new liquidity long-term lending facility, and they hadn't done that since 2016. For a while now, just people in the market have been thinking that the ECB has really been making a policy error by kind of being too hawkish in their language. And so this really went to show, this introduction of the long-term lending facility went to show that the ECB has kind of capitulated on that view, and it's about time that they have. The euro was impacted on the day. It really weakened. It went through 112 support on the day that Draghi spoke. But what was really interesting in the ECB press conference was that Draghi brought up himself that the ECB left the balance of risk to the downside. And normally what the ECB does when they take some sort of policy action and slash their growth forecast is they put the balance of risk to neutral. And so this was an unusual event, which is also what we like in global macro. So he was asked about it by a reporter, and he explained it as such that the ECB obviously can only control, the domestic economy in terms of monetary policy, but there's other factors externally which are going to negatively impact the economy. One is Brexit, and the other one is trade negotiations. And so he just said, look, monetary policy of the ECB has no control over those two things, and so that's why the risks are still to the downside. And so, I just think that this is going to continue to weigh on the euro, and just in general, looking at the other side of the trade, the US dollar. It's a safe haven currency. And so all of these uncertainties kind of globally, I think they act to strengthen the US dollar. And that's, the other side of the trade, just remembering that the US dollar will remain strong. If you look at yields in the United States, 10-year and 2-year, they've really come off, they've lowered, but the dollar has remained relatively strong despite that.
Do you see the US economy in any way impacting this trade, or is it really global weakness is going to be the dominant factor here?
I think global weakness is going to be the dominant factor. All of these uncertainties, markets in general like certainty. And when there's all of these uncertainties around, they tend to flock, or investors tend to flock to safe haven assets. And in currency land, that's the US dollar and that's the yen.
Now, in terms of the euro dollar trade, what levels are you looking at? It had been trading in pretty much a range before Mario Draghi had the press conference. Where do you see that going?
So I'd be short euro dollar around the current level, which is 112.75. I'm looking for an initial target, which is quite far away, at 103.50, and a secondary target at parity with the US dollar, which is pretty big. I'm going to put a stop for the initial target one up at 114.40. So it's entering at 112.75, 103.50 is the target, 114.40 is the stop on that portion of it.
Euro dollar parity is a pretty bold call. What makes you think it's going to fall that far?
I think Europe is in a growth slowdown that's heavier than they're realizing at this point. And we don't have clarity on Brexit at this point. It looks like it's going to be pushed back and delayed, but still, it's just creating too much uncertainty, I think, still for the European Union, which is going to negatively impact their economy and negatively impact people's investments there, basically.
So what's the time frame on the euro trade?
It's a little bit longer term, so it's 3 to 6 months. So 3 months for the initial target of the 103.50, and we're looking at more of a 6-month horizon for the parity call.
These trades are all about global growth slowdown. What do you see as the biggest risk to this overall?
Overall, especially for the euro trade, is that growth in the eurozone picks back up or doesn't slow as precipitously as it's looking like it will slow right now. Also, maybe we'll get a more orderly either exit for the UK out of the European Union, or it'll be pushed back beyond 6 months, so it doesn't become a factor in the next, like, say, 3 to 6 months anymore. In terms of Australia, the RBA has told us what to look for, and that's wage growth. The RBA is really counting on wage growth to further support the economy. So if wage growth starts to pick up in Australia, then you want to back off the short Australian dollar trade, because things will start to look up for the economy there. And conversely, if wage growth doesn't come through, you want to keep that trade on, because it's just one more pressure adding to the economy and adding to the Aussie dollar.
And what about Canada?
Canada is interesting. They've had really a strong job market, kind of similar to Australia. So Canada's a little bit tied to the fate of the U.S. economy. So should the U.S. economy slow more, that certainly would negatively impact the Canadian dollar. Conversely, if just the job market stays strong in Canada, and maybe we get some wage growth in Canada as well, consumer spending will pick up. So if consumer spending starts to pick up in Canada, I think you can back off that trade as well.
Great. Can you break down all 3 trades in 30 seconds?
Sure. So on global growth, these trades are about global growth concerns. So I'm short the Canadian dollar, I'm short the Aussie dollar, and I'm short the euro dollar.
Great. Amelia, thank you so much for breaking this down for us.
Thank you so much for your time.
So Amelia's bearish on the Australian dollar, the Canadian dollar, and the euro. Specifically, she recommends shorting the Australian dollar if it breaks below 70 the figure, with a stop loss at 71.45 and a target price of 67.45 over the next 3 months. She thinks a currency pair could reach as low as 60 the figure over the next 6 to 8 months. Amelia also suggests going long USD CAD at 133.70 with a stop loss at 132.40 and a target price of 136.40 over the next month. And finally, she recommends going short the euro at 112.75 with a stop loss at 114.40 and a target price of 103.50 over the next 3 months. And she thinks the euro could ultimately reach parity with the dollar over the next 6 months. Just remember that this is a trade idea and not investment advice. You should do your own research, consider your risk tolerance, and invest accordingly. For Real Vision, I'm Justine Underhill.